I'm Verl Workman, licensed real estate agent, professional speaker, and real estate coach. Welcome to another ISM financial educational video. This video is from our real estate series. On this video, I'll be talking about reverse mortgages. A reverse mortgage is a loan available only to seniors that is used to release the home equity in the property as a lump sum or in multiple payments. The homeowner's obligation to repay the loan is deferred until the homeowner dies, the home is sold, or the owner leaves, for example, into an elderly care facility, a nursing home, or even assisted living. In a conventional mortgage, the homeowner makes a monthly amortized payment to the lender. After each payment, the owner's equity increases within his or her property, and typically after the end of the term, the mortgage has been paid in full, and full title to the property is released by the lender to the homeowner. In a reverse mortgage situation, the homeowner makes no payments and all the interest is added on to a lien on the property. If the owner receives monthly payments or a bulk payment of the available equity, then the debt on the property increases each month. To qualify for a reverse mortgage in the United States, the borrower must be at least 62 years of age. There are no income or credit requirements, but there are other requirements, and homeowners should make sure that they qualify for the loan before they invest significant time or money into the process. You may qualify for a reverse mortgage even if you still owe money on an existing mortgage. However, the reverse mortgage must be in a first lien position, so any existing indebtedness must be paid off. You can pay off the existing mortgage with a reverse mortgage, with some of the money from your savings or even assistance from a family member or a friend. For example, let's say that you owe $100,000 on an existing mortgage. Based on your age, the value of your home, and interest rates, you qualify for $125,000 under the reverse mortgage program. Under this scenario, you'll be able to pay for all of the existing mortgage and still have $25,000 left over to use as you wish. If, however, you only qualify for $85,000, then you would need to come up with $15,000 from your own savings to get the reverse mortgage. Even then, all of the money from the reverse mortgage would have been used to pay off the existing mortgage. On the other hand, you won't have a monthly mortgage payment anymore, and that's nice. Once you've paid off any existing mortgages, the proceeds from a reverse mortgage can be used for just about anything, whether it's to supplement retirement income to cover daily living expenses, repair or modify your home, pay for health care, pay off existing debt, buy a new car, or take a dream vacation, even covering your property taxes or preventing future foreclosure. That money can be used at your discretion. The amount of money available to the customer is determined by 5 primary factors: the appraised value of the property, whether health or safety repairs need to be made to the house or whether there are existing liens on the home. Number 2, the current prevailing interest rate as determined by the U.S. Treasury one-year Treasury bill, also known as the LIBOR index or the one-year CMT, constant maturity Treasury rate. The third is the age of the senior. The older the senior is, the more money he or she will receive. Number 4, whether the payment is taken as a line of credit, lump sum, or monthly payments. Line of credit will maximize the money available, while lump sum provides the cash immediately. But the interest fees are absolutely higher on that type of a loan. Monthly payments are set up as what is called a tenure payment, which means that the borrowers receive them for the rest of their lives, no matter how long they live. Number 5, the value of the property, and whether that value is higher than the national loan limit set by HUD. The current lending limit, which is the maximum a home can be appraised for no matter how much it is worth, is $625,500. The money received from a reverse mortgage is not taxable and does not directly affect Social Security or Medicare benefits. However, an American Bar Association guide to reverse mortgages explains that if borrowers receive Medicaid, Social Security income, or other public benefits, loan advances will still be counted as liquid assets if the money is kept in an account, like a savings or a checking account, past the end of a calendar month in which the money is received. The borrower could then lose eligibility for such public programs if his or her total liquid asset is then greater than those programs allow. It's important to note that the homeowner must ensure that taxes and insurance are kept current at all times. If either taxes or insurance lapse, it could result in a default on the reverse mortgage. A drawback to reverse mortgages are the high upfront costs. This upfront cost is tempered by the lower interest rate over time. But some seniors choose other options to draw on their home equity, particularly if they don't plan to remain at the property more than 5 years. The cost of getting a reverse mortgage from a private sector lender may exceed the cost of other types of mortgage or equity conversion loans. Exact cost depends on the particular reverse mortgage program the borrower acquires. The most popular type of reverse mortgage in the U.S. is the FHA-insured Home Equity Conversion Mortgage, or HECM. Typical fees for this type of reverse mortgage, including mortgage insurance, origination fees, title insurance, appraisal, survey and recording fees, can be as much as $15,000 or more, as compared with other types of loans which often cost less than $10,000. However, all of these costs can be financed with the proceeds of the loan itself. Some state and local governments offer low-cost reverse mortgages to seniors. These public sector loans generally must be used for specific purposes, such as paying for the home repairs or property taxes, but most of them don't have more affordable interest rates and fewer or no fees associated with them. These programs are typically very restrictive in terms of qualification and location, and many regions and states and areas don't have such programs at all. Under the right circumstances, a reverse mortgage could be a great solution for seniors who like to take advantage of the equity in their homes today. On the other hand, reverse mortgages are not for everyone. As a general guideline, if an individual intends to leave their home within 2 to 3 years, there may be other less expensive options to consider, such as home equity loans or lines of credit. Also, if you want to leave your home to your children, then you should consider other options because in many cases, the home is sold to pay back that reverse mortgage.